Hello everyone, and thank you for joining us today. Welcome to the second in a new series of webinars from the Airline Economics, which are focused on assisting the aviation industry through these unprecedented times. My name is Victoria Tozer-Pennington, the editor of Airline Economics magazine, and I'll be hosting today's webinar to again discuss the impact of the novel coronavirus, COVID-19, on the aviation industry. But this time around, we'll be doing it from the perspective of expert speakers based in Asia. So before we begin, a few technical items. If you need any technical support at any time during this session, please use the chat button located at the bottom right of the page to ask for help. Please do submit any questions you have for the speakers at any time during the presentations using the Ask Your Question box, which is beneath the player window. We'll have time close to the end of the webinar to pose some of these questions to our panelists. If you have a specific question for a specific speaker, please say so. We'll try to answer many of them, but if we run out of time, we'll try and get back to you personally after the event. So slides will not be shared automatically today, but you can request a copy from the individual speakers after the event. So our experts panel today are going to discuss the continuing coronavirus crisis that's engulfing the entire aviation industry. Since our first webinar on this subject at the end of March, the crisis has deepened, with the severe economic impact of a lockdown in many countries beginning to be realised. Although hopefully there are signs that the disease may be reaching its peak in the current epicenters of Europe and North America, there are calls for the lockdown, or at least social distancing, to remain in force for some time. Airlines have begun to receive government assistance, but without a return to service soon, it remains unclear how many will survive. There is perhaps, though, a chink of light at the end of the tunnel, as restrictions are slowly being lifted in Asia, with some flights resuming. The world is watching to see how the region recovers first. So opening this discussion for us today is Peter Negline, Head of Strategy and Market Research at BOC Aviation. In his current role, Peter is responsible for advising the CEO and senior management on factors external to the company, including the global macroeconomy, financing markets, airline performance, aircraft manufacturers and competition in the aircraft operating leasing market. Prior to joining BOC Aviation, Peter was Chief Financial Officer of an Asian-based low-cost. He was also a research analyst covering the Asia-Pacific transportation sector in Hong Kong for 12 years. He's also worked on many financing investments, including Qantas public offering in 1995. So thank you, Peter. If I turn this over to you to open the discussion today.
Thank you, Victoria. And I'd like to extend my greetings to everybody from Singapore and congratulate everybody on making it through another week in lockdown. So again, thank you to Airline Economics for hosting today's webinar. And for those of you not familiar, allow me just a quick introduction of BOC Aviation. We are a global aircraft lessor with a platform based or headquarters here in Singapore. The last published number, we had $19 billion in aircraft assets. We focus on aircraft with 100 seats or more, or the freighter equivalent, with ages less than 10 years. As at the end of March, we owned 323 aircraft. We had an order book of 204. Our total owned, managed and on order was 567, with 92 airline customers in 40 countries. Now, I suppose we can't really discuss COVID-19 without expressing our condolences for the loss of life, and it's quite tremendous across the world, and our sympathies go out to everybody who's been impacted by the disease through the loss of loved ones during the pandemic, and it's sad to sort of think that there will be more loss of life in the days and weeks to come. But we should express those sentiments up front. Just to outline the contents of our presentation, so we want to set the scene. We want to highlight the sudden impact, if you're not, you should be all aware of that, around COVID-19 and how it hit the airline industry quite dramatically. The governments have provided substantial support along with the central banks. And we will primarily focus on the US, simply because it's from an aviation point of view, we look at a US dollar industry. So the dynamics there on the financial and fiscal and monetary side are most critical for us. We'll quickly touch upon the recent traffic trends. We want to talk about the key issues with China's recovery, what we see slightly different in the developed world and the outlook there. You can't really discuss aviation without touching on jet fuel, air freight, and of course the environment. And then there's just one or two brief issues on the outlook for older aircraft that we want to touch on before we wrap up. So if we set the scene for today, the unfortunate thing is that viruses, as you know, require in advance great preparation. And the reality is that no country was well prepared for this virus. And that's in two respects. One is in a physical regard, where there was just not enough equipment. Every country is short of ventilators and medical equipment, and everyone's short of personal protective equipment in particular. They're trying to balance that out, but we started all of this with great or greatly ill prepared. And the other element is education, where the average population need to be aware of what behaviour is required to help control these viruses. And as this education has now taken place or taking place, it's going to leave us hopefully much better prepared for what could be some unfortunate relapses or repeats of this virus, perhaps in the next winter or thereafter. Now, we will come back to the issue about the airlines. They're one of the very few industries in the world that have substantial, 11 months in advance forward bookings, and that provided quite a lot of intelligence to our industry in terms of what was coming at them, more than most other industries were not able to benefit from that. And we do need to talk and congratulate governments for their rapid cutting of interest rates, the wage supports that they've provided, and the corporate loans and so forth that are falling into place at the moment. But the reality is that doing nothing for most governments was not a political option. We need to understand that all these countries have to prepare and support their economies to ensure that there is something left of the economy as we come out the other side of this dreaded disease. Now, please note that airlines do not live in a vacuum. We are part of the larger travel and tourism industry, and our success is not only part of it due to our own execution on the airline side in particular, but the hotel industry. We also rely on restaurants, taxi companies, the likes of Uber. Here in Southeast Asia, there's a company called Grab, and so forth. All of this is a key part, stakeholders in the broader travel and tourism industry, and we need all of that to be supported to help the growth and recovery in air travel. Now, we also need to talk a little bit about the economy and just the broader and dramatic destruction of personal incomes around the world. That is going to force changes of lifestyle in many different respects. And we don't know exactly what those changes are at this point. And it's worth considering that some people look back at the GFC, the global financial crisis, 2008, 2009. It was just after, or just prior to that, I should say, was when the smartphone became part of our lives. It feels a lot longer, doesn't it? But are any major technologies and changes going to happen through this crisis that's going to change the way we do things? And 5G may be part of that, but there could be other things in the background that we haven't yet seen that could emerge from all of this. China is recovering, as we said. There are lessons to be learnt from what China's doing, and the pace of recovery will also be interesting to monitor, and we'll provide you some data on that. We have praised the governments already for their financial support, but what is a concern is the interference or scope that governments will now have to determine how and when flights resume. And there's also going to be a dynamic around the issue of industry regulation. Will governments nationalise airlines? Will they be picking winners and losers amongst which airlines survive and all of that? And that sort of introduces lots of issues that create lots of emotions in certain circles. But nevertheless, we still see a strong motivation for aviation to get back flying. Now, I'm not saying it's everybody. I'm not saying it's all routes. It's not going to be all aircraft, but it will. There's definitely a visiting friends and relatives that need to get going. You think of some of the speakers on this call live away from their country of birth. Family is scattered around the world. There's all of that. I mean, there's business travel, and we'll come back to these issues later. There needs to be some recovery there that certain parts of the economy will need as soon as it's safe to do so. Now, we are witnessing, we know that aviation is a very cyclical business, and we are probably at a very extreme point within that cycle. But from an aircraft leasing point of view, if you don't want to buy at the top, you need to buy at the bottom. And we saw a very toppy, expensive aircraft markets over recent years. Those conditions have become more favourable from our perspective, and as far as we're concerned, things have become more favourable. Now, it is obviously a time for investors to come into this market where they have the staying power to come through this out the other side. And as you'll understand, making forecasts around COVID is a very humbling experience because there's just so many factors that can be, so many things generate outcomes that are unexpected. but nevertheless, we don't see things staying very bad for a very extended period. Now, let's talk a little bit about the pandemic. As we said, the government's response has been, in many cases, many governments, has been very comprehensive. And it needed to be because the virus has been so indiscriminate. You think of all the sectors that have been impacted between air travel and tourism that we've already discussed. We know there's been so many restaurants and cafes and all the rest closed. I was fascinated to see yesterday that the US Mint, which has forward sold all of the coins it can produce for the rest of the year, can't actually produce them because of the risk of infection amongst its workforce. And workers have been indiscriminate, whether you're professional or blue collar. Dentists are now out of work. We know the entire construction industry has stopped. Hollywood actors are out of work. A lot of big music acts. And of course, the issue around the closure of sports and all that has been very debilitating. It's fascinating at the moment. If you want to watch Roger Federer, he's more active on Twitter than he is on any tennis court right now. And that's not really good for anybody. Well, he's actually got a better sense of humour than I expected, at least. So he's quite interesting to follow. But you'd really rather see him on a tennis court anyway. Now, airlines are unique in a global context because they have such large databases, as I said, with their 11 months forward sold revenue. They can see that future activity. They saw rapid cancellations through the late part of February and March. And the nature of those cancellations was a very strong sign to many airlines of the severity of the public reaction here. So the quick response of airlines to cut costs, ground capacity, furlough staff, as unfortunate as all that is, was a necessary consequence because they could see that the revenues evaporating so quickly. Now, we know that governments were going to be a factor in airline behaviour here anyway, because the stress point for every country and community is around its health services. And governments have to protect all of that for the society at large. So flight cancellations were just a recognition of the role that airlines had to play to break the means of transmission of this disease within borders and across borders in particular. Government's assistance has also been needed to bring back a lot of small businesses. And we've talked a little bit about the vulnerability of all of that with the loss of cafes and the rest. But some of these industries, to some extent, have a structure that we've got to wonder whether it's sustainable in the long term. You hear that 90% of all restaurants in New York failed in their first year, that hotels have really no more than 24 hours certain visibility on their bookings versus 11 months for the airline industry. Are some of these industries sustainable? The movie industry, I mean, 9 out of 10 movies never make money. So are we going to see a lot of industries go back and sort of rethink how they do things? And I certainly think to some extent the airline industry is going to look at airfare pricing and realise that they do probably need to add some premium to tickets and build bigger cash buffers in the longer term. We've also seen the airline industry hit pretty hard, as I've mentioned. Airport workers have been furloughed. We know that there's been a dramatic cut in maintenance spending. There's also been, well, at the moment, there's no need for food catering of any significance. And we've also know that the airlines are going to be thinking very hard about the number of aircraft they need and utilisation rates and so forth. I mentioned also the fact that the role of governments in the recovery of the industry in terms of will they want to pick winners? Is there the risk of nationalisation? And I know within some aviation policymakers there's a definite fear that privatisations could be reversed and take us back many decades, which may not be good for the industry in the longer term. Nevertheless, we remain hopeful and won't rule out the possibility that there will be some better news towards the middle part of the year. I lived through the SARS experience, and I know that SARS is not COVID-19, but as things did improve and as the medical profession became more knowledgeable about the disease and as the people's education and behaviour improved, we were able to get on top of that disease, and maybe warm weather helped to some extent as well. But let's not be sitting here so negatively and saying there is no prospect, where we are seeing improvements in Austria, Denmark and the like, that justifies some improvement in the overall speed and activity within the economy. Now, I think to some extent within the US context, the government initiatives, as I said, they've been substantial, but I just wonder whether James Bullard, who's the president of the Federal Reserve Bank of St. Louis, his very simple, direct comment that the government had to move forward with substantial fiscal initiatives and monetary initiatives from the Federal Reserve as an investment in the future of the country, of the US and the American population. And that same thing applies whether you're talking about European nations, here in Asia and so forth. Relative to past experiences, the government's responded pretty quickly, and I think that's been an admirable performance. Behind the scenes within the US, we detect that there's very high levels of cooperation between the Federal Reserve and the US Treasury. Now, please note, under US law, the US Treasury is able to spend money to support the economy, and that's, as I said, through an act of the Congress. The Federal Reserve has no ability to spend; they only have a capacity to lend, and the Federal Reserve needs to be repaid. And the Federal Reserve also has the ability to leverage what Treasury put in these different funding facilities, and there's now 9 facilities, and as you know, several $1 trillion. Now, my understanding is that the strategy that they're broadly looking at, and it's something that we saw in the global financial crisis, where the Federal Reserve bought a significant amount of assets of different types. They put them in various different special purpose vehicles, and over the next 5 to 10 years, traded out of a lot of that actually at a profit. Now, this is doing it almost on steroids compared to what they did in 2008, 2009, but there is a playbook, there is a game plan, and they're executing to it. The Congress is now putting in place all the different support, and I think this is going to be one reason why we're a little bit more optimistic on the economic side, because there is so much firepower sitting on the sidelines, and we'll come back to this in a minute. I suppose the other sort of thing that I want to mention here is that the Federal Reserve is standing in the market to absorb assets, as they say, to capture the illiquidity premium that panic selling has put into markets. So the job of the Fed is to soak up, to break the panic selling, and as soon as they've broken that panic, the markets and economy and lending cycles within the banking system and so forth can get back into action. It's fascinating and fantastic to see that the small business lending facility that they've put in place, $352 billion worth, is now fully allocated. That just shows you, first of all, the effect, the need for it on one hand, but the fact that it's there and it's being spent is fantastic. We also appreciate that the US has specifically mentioned the airline industry as worthy of support. It's one of the few industries that specifically mentioned, and it's great that the US airlines have finally agreed a deal to borrow funds this week. We do see indirect references in the legislation to support for the manufacturers. There has been significant facilities put in place in Europe to support Airbus, and we believe that the governments can't afford to lose, first of all, on one hand, a significant export industry, but we also know that aerospace manufacturing, the skill base there is incredibly valuable to the countries in the longer term. So the manufacturers have their support, direct or indirect, at the moment. There is going to be, as a consequence of all of this, significant increase in fiscal deficits, and the balance sheet is going to expand multiple times. We'll touch on that in just a moment. But let me point out one thing. Okay, so we're going to see deficits grow. We're going to see money printing is already going on. But please keep an eye on the gold price. The gold price, the rally there is suggesting that there's a possible rebound coming sooner than you think, that the central banks will not be able to withdraw all this excess money, and that's creating a fear down the road of inflation. So we have the pessimists on one side saying that the world is going to end, and on the other side, the gold price is saying to you that there is going to be a reason for inflation, which can only really come about if the economy gets back to work with a large stack of additional liquidity, and there's an inconsistency there. So I wouldn't rule out this notion that we must be cautious, we must be careful, we must be confident in our position, and as I said, humble in our forecasts. But let's not be too negative here, because the gold price is suggesting that things may be a little bit better in the longer term than you think. Let me move on to the central bank assets, just to show you. Let's focus for a moment on the blue line. You follow that from the left-hand axis, where the blue line is the Federal Reserve assets. They've added $2 trillion worth of assets in the last month. The grey line is the assets of the ECB, and that has started to grow as well. China has not really seen much improvement or growth in its overall balance sheet, but please keep in mind that China has significant scope to grow or to lend money in the domestic economy by lowering its bank reserve ratio requirements. It's currently sitting at around about 12%, and every 1% generates broadly about $100 billion of lending capacity within the market. So there's a significant amount of work and support that the Chinese government can provide through its own banking system. Let's move on to the traffic side. So you see the US chart on the left, and these are thankfully data that's come from the TSA. And on the right-hand side, China's Ministry of Transport shows you the daily traffic. And we show you, first of all, the total, which is the dotted line, red off the left-hand side, and the airline passengers on the right-hand side. So it's interesting that they're both at the worst point. We're down about 93, 95%. China has since recovered. We'll come back to the specifics of that in a moment. But earlier in the week at a conference or a webinar, IATA said their definition of a V recovery was to have 3 months of decline in traffic, and after 6 months from the start of the problem, that the traffic was back to where we began. And China doesn't look as though it's going to quite get there. So the notion of a V recovery is probably something we need to move beyond. Let's, just in the interest of time, I'll sort of talk a little bit about China. China's first to recover, as we said earlier on, and it does offer some lessons for other countries. It is focused primarily on domestic or the recovery in its domestic market. The overall capacity in China is down about 45% relative to where it was at the end of December last year. The domestic side is down about a third at the moment. International is down dramatically still because China's worried about the risk of importing cases from abroad. From the very lows in February, the traffic has recovered just over 200%. But we're travelling at about a couple of 100,000 passengers a day, and previously it was in many multiples of that. So we've still got a long way to go. The CAAC has issued guidelines for airlines and airports in terms of comprehensive rules on what's required to protect staff and passengers in flight operations. And there is actually a long list of instructions around disinfecting of aircraft. All of this is necessary to create the confidence for travellers to feel safe to travel again. But what I worry about is just it's going to make it very difficult for airlines to operate while these rules are imposed. Nevertheless, China, there's a first week of May is an important holiday period for China. It's only two weeks per year in May and October. They don't want to lose the opportunity of the travel there. So they are looking to try and restart as much of the domestic network as they can. But China can't afford to be reckless here. It wants to reopen its economy and allow the more travelling around its domestic markets. But it can't afford to forsake the success that it's had to date in containing the disease. So China will be sort of very cautious the way it moves forward. As I said, the international side will have a phased restart and will be very, very slow to grow. But can I also just highlight, China has a very dramatic or substantial high-speed rail network, and there is some signs of a price war going on with the railways actually fighting for market share there. So the airlines will have to deal with that problem as well as trying to get more passengers to the economy recovers. Let's talk a little bit about the developed world. We see that the introduction of social distancing, working from home, the emphasis on washing hands and so forth is all going to, as we said earlier, improve the chances of beating this virus. But again, we want to congratulate the airline industry for quickly acting in its own best interests. That was despite the unfortunate loss of jobs. But we all need to, for those of us who are employed, need to work hard now to get those jobs back into action. The airlines have worked very hard to retain their cash. This is something we haven't seen before. It's become quite a contentious issue in certain jurisdictions. But I think the airlines have been very proactive here, and I congratulate them for that. I understand the issue of protecting consumer rights, but I suppose from an airline perspective, we don't want to see too many people exiting the industry because of this issue. There are more airlines that are going to be announcing or have announced capacity cuts and groundings through the second quarter. But as I said, hopefully as we get into the summer, we do see some improvement. And it might be necessarily too hard to see an improvement because we are coming from such a low base. As I said, we don't have to see improvements in every market, every city pair, every aircraft back into action. We just want to see an improvement from the very, very low base that we sit at the moment. We know the airlines are working very hard to study the relaunch of services. The government regulations in terms of what they can and can't do is going to be part of that. But the airlines also need to understand what's going to inspire the return to travel. And I did appreciate yesterday Michael O'Leary's comments that he's going to be lowering prices to very small numbers to stimulate traffic. And we know that business travellers have to get back out there because out of sight, out of mind is not good for a lot of customers. That certainly applies in our business. And as I said, visiting friends and relatives or family is really a key part of the market that's going to rebound in part to begin with and in whole, hopefully, over time. The airlines are doing a lot of analysis around what routes they can open, where they need to be pricing tickets. Delta's announced or volunteered that it's going to block the middle seats. And I know India is not a developed market, but the government there the other day was announcing that it may look to, in a narrow body economy class, have alternating a passenger on the window, the next row, the passenger has to sit on the aisle. So they'll be blocking 2 out of every 3 seats. A lot of this, I understand the medical issues, but from an economic point of view, it's going to be very debilitating for airlines. So we need to sort of spend more time studying which business models are going to survive here. But we are very happy to hear when Michael O'Leary spoke around the issue of his wish was to get pilots, cabin crew and aircraft back to work. And he said that was more important than his business making profits. Things like that are a sentiment that is really important for our industry. Now, when we think of the airline industry, we can't go without talking about fuel prices. This chart shows you monthly average prices. It's based on the Singapore jet fuel price. It's what our airlines actually pay on a monthly average. It's the first time in many years that the oil price really hasn't been an issue for airlines simply because they're not flying if they're unhedged. And if they are hedged, then they probably want a higher price because the real or paper losses for many airlines are significant at the moment. And the risk of margin calls must be quite significant. And I just want to bring up that chart mainly to highlight, please don't lose sight of the fact that anybody who's heavily hedged here will be sitting fairly uncomfortable. And whilst they've got short-term issues around the practical side of their business, there's also financial risks associated with fuel hedging in particular that may be a problem for them. Let me touch on air freight and the environment. The demand for air freight, when I say it's robust, I suppose I should have elaborated. It's specifically around the issue of dedicated wide-body freighters. We see a robust outlook, and that's mainly because of the withdrawal of passenger aircraft that account for typically around half of global air freight capacity. We know that there's urgent medical shipments and all that's driving a lot of flights at the moment, but it's really e-commerce is where the long-term potential is here. With us all based at home, that's exploded. And what's my evidence? Well, just go look at the Amazon share price, up 1/3 this year. There's a lot of Chinese e-commerce names, the likes of FS Express and so forth, up similar 30%. Their performance is sustainable. And we know that there's a lot of airports wanting to talk more to these guys about the opportunities that they see building out distribution centres at airports and the like. For the environment, it was funny in the UK press recently, a cartoonist with the backdrop of an airline name in their cartoon sort of saying, well, we're finally going to achieve our emissions targets now that our fleet's grounded. And it's a nice joke, but the reality is that we'd rather the airlines be flying. The international aviation this year has to deal with setting targets around Corsia, set last year and this year, and the collapse of capacity this year is going to greatly disrupt those plans. So we know that the short-term focus for airlines and governments is around airline survival and supporting the travel and tourism industry, but it does beg the question whether the airline industry, in conjunction with regulators, needs to move on with the issue of environmental protection, the climate change issue, and actually put Corsia aside. It does expire in 15 years. Should we be creating a new system here and a new timetable? And that may well come about. The last issue I just want to touch about is on fleet retirements. This is data from Cirium. It's just under 4,000 aircraft in the 100+ seat category, both passenger and freighter. We see we'll be reaching 20 years this year or even older. The airlines may consider some accelerating retirements. Now, 2/3 of the aircraft out of our cumulative total of 3,800 passenger aircraft. The logic for our reference here is just if the airline industry is going to make large losses, and IATA will give us their forecast in the next month or so, it's probably the right time for airlines to consider writing off older, inefficient, unprofitable aircraft where the cost of exit is minimal. And we've seen in the last weeks, Lufthansa and American announced accelerated retirements of in the order of 150 or so aircraft. And I'll leave others to speculate on whether the future of the A380 was troubled in advance, but it's probably more troubled right now. So just to wrap up here, we are looking for, within the economy, for signs of structural change and which ones of those are going to be permanent. we understand and see a permanent, talking of permanence, the issue of human desire to travel, it will resurface, and you can only keep everybody cooped up for so long. We do want to see the entire travel and tourism sector rebound, and we hope that cheap tickets will be part of that. We know the medical side, we do need accurate testing of this disease. That's going to be a key part of building confidence of air travel. You don't really want to be sitting in a plane knowing that someone nearby could be positive. And we do hope that governments will manage their influence around the industry structure and future airline ownership and so forth. We do see, as I said, older aircraft possibly in the firing line here. So we don't know and we can't predict when COVID-19 will be eradicated, but we do know that good investment opportunities in this cyclical industry don't last forever. Now, as I said, in SARS, we saw that between the time for the medical profession to build their knowledge for the better behaviour and education amongst the public was all, along with warmer weather, a key factor in helping that virus die off. And we can only hope that some or all of those factors help for a quick end to this disease. In the fullest sense, obviously is what we really want, but let's do it in baby steps. Finally, allow me to leave you with the final thought. I've heard a number of private sector economists referring to, we will get back to the 80% economy. And it goes back to my earlier point where we said that we can't have everything recover immediately because there's just so much destruction of jobs and incomes and the like. But if we can get back to 80% fairly quickly, that would be fantastic for the airline industry. So on that note, I'll just remind you, don't forget about the gold bugs. They see the economy recovering. And let's hope the greatest problem that we have in the next year or two is just helping the Fed shrink its balance sheet to make sure there's not too much money chasing too few goods. And with that, I will conclude.
Thank you, Peter. That was a great overview there. We have a lot of questions for you, which we'll take at the end. But first, we're going to hear from Peter Morris, who's the Chief Economist at Ascend by Cirium. He's responsible for a variety of project areas concerning airports, airlines, market demand, forecasting, as well as new aircraft and product research. Prior to joining Ascend, he was IATA's Chief Economist. Thank you, Peter Morris. Over to you.
Well, it's always nerve-wracking when you follow another Peter who's going to cover much the same ground as you're going to do. But actually, I think our presentations are going to be quite complementary. What I wanted to talk through is some of the observations that we see so far and some degree of speculation about how this process might continue. A colleague of mine gives a very good analogy looking at the collapse of a building, and we're currently at the stage in this crisis of the collapse of the building, and we've got to establish whether or not the foundations are still robust, whether or not the plumbing's still there, the electricity's working, and how we build out from here. So just some comments, again, complementary to what Peter said, is that COVID-19 has driven a global crisis, and it's drastically impacted, as you know, both economies and aviation. So there are numbers on the number of cases, now over 2 million, and a death toll over 130,000. On the other hand, you are seeing that the new daily cases are currently declining in China and South Korea and Japan, stabilizing in a number of European countries, albeit at a high level, and increasing at the moment within the USA. So you are seeing a process sweeping round the world, and that again makes it more difficult to talk in terms of the rebuilding process, because clearly an international interconnected air transport business is something that relies on links and hubs all the way around the world, not just on a domestic footing. It's basically a proximity virus, and the problem at the heart of it is that travel and tourism requires close proximity in order to get its economies of scale. There's been widespread lockdowns, travel bans, and international air networks are basically ground to a halt. So looking at the travel and tourism worldwide, and again, as Peter mentioned, you need to look on this as a complete supply chain. So you've got a $10 trillion business that's being put on hold for at least 3 to 6 months, and again, needs to rebuild after that. The whole supply chain and the booking cycle. So in other words, you're looking at losing a good proportion of the Western Hemisphere summer bookings as a consequence of this booking cycle not working. The next thing is that if you go back in terms of precedent, then the aviation industry has faced multiple demand crises, but nothing as systemic as this one. At the moment, there are no clear navigation aids, and GDP forecasts, customer confidence levels are all spiraling down, and travel regulations are increasing, along with massive government intervention, particularly on the supply side. The situation, in summary, will improve, but the timing and scale of that remains particularly unclear. This is quite interesting to see. This is a development of the map that Victoria had at the beginning, which was taken at an earlier stage. But what you do see from this is that 3 epicenters of disease are very similar to the 3 epicenters of the core of the aviation business, i.e. Asia Pacific, North America and Europe, and as a consequence they are pretty much tied irrevocably together. If you look at the 3 key factors driving demand for air travel and the timing and scale of the recovery, I think you can put it into 3 buckets effectively. So you've got the economy, because the economy is what drives the air transport industry, with historically a gearing of around 2 to 1 between air travel revenue passenger kilometers and GDP. And so any degree of recession, and we're clearly going to see a recession this year, which is going to extend to around 6% and counting for the G7 nations, and taking it down to around a 1% growth from a level of 5–6% growth from developing countries. So overall, you're looking at a recession of the order of 3% at the moment. But as I say, we're still in the process of the building collapsing. So as a consequence, that 3% is probably an interim figure before more information comes in. On the customer choice side, what you're seeing is that people are choosing not to travel. And clearly, in rebuilding demand, something has to be done to get people on both the business and leisure markets making the decision that they do want to travel again. And the third element of this is the whole permission to fly. So in other words, governments have intervened at levels to either say what airlines can or can't do, or what passengers can or can't do that are on board those airlines. And again, with an interconnected network system, it makes it more and more complicated if you have 200 or so autonomous nations taking different decisions about what those regulations may or may not be. On the supply side, one of the key elements, it's all very well having customer choice coming back, but if the airlines aren't there to actually provide the services because they've gone bankrupt in the interim, you clearly have a major problem. So there is something that goes right the way across the economy, business structure, government support and customer choice. That means on the supply side, there would actually be support available to provide that aviation business. So just from some of our databases to document the degree of unraveling that we've seen, this is what is very difficult is looking at schedules and trying to interpret them, because schedules have been changing continually like falling knives all the way through from February. But this is a documentation based on tracking the actual flights that are flown and the flights that were planned to leave from the airport and the ones that actually did. And so you can see globally, in January, the figure was around 4% up year on year for global flights. And since then, there was first of all the China-Asia impact that you saw, followed by the impact throughout the rest of the aviation business. And so you can see there in green the in green, you can see the flights are actually flown, and so you can see a higher level of cancellation because flights were scheduled and then compressed together in the light of the declining demand. If you look on for the United States data, you saw that was maintained a lot longer, although there was, of course, a very significant price. We saw some data from A4A that was looking at the impact in terms of load factors on board domestic flights, which were down to the teens, basically. And that's for an industry that was previously performing at around 80% in order to achieve its economic return. So it's not just a question of flying the flights, it's also a question at the same time of being able to have the passengers on board that want to travel. And so you see the much higher level of cancellation, even though it was planned to maintain these flights. When you actually looked at what happened at the airports, you saw this very high level of cancellations within the US. In China, again, Peter mentioned the recovery. If you look at the track flights, then we've seen a little recovery, principally on domestic routes since the beginning of March, although the level of cancellations and compression of flights together is clearly quite high. The other side of that is that if you actually look at the utilization in terms of the number of hours a day the aircraft are being operated for, you can see the dramatic reduction in the number of hours that the either wide body or narrow body aircraft are being used for. And so while you've seen an improvement in the single aisle utilization over recent weeks, because of the impact, particularly on international flights, you're seeing the utilization has declined very significantly on wide body aircraft. If you just take a snapshot looking at, and I did this for April the 15th against April 16th last year, so looking at the same basic day, and for the three key aviation areas, what you see is that in Asia, at the moment, you're seeing a schedule that's around 47% down in terms of the number of seats compared with the year before. You're talking about 94% down in Europe, and in the US at the moment, you're talking around 63% down in terms of the number of scheduled seats within North America. So those three principal areas clearly have had the stuffing knocked out of them, although there are some glimmerings of a degree of return, particularly in the Chinese domestic market, but you can see it's still got one heck of a long way to go. In terms of the 2020 outlook, if we look at the latest publication from IATA looking at 2020, then they're talking about revenue passenger kilometers, so in other words, the demand measure within the industry, dropping by nearly a half overall. And that's pretty well spread over all the different individual areas. And the impact on the passenger revenue side, you're seeing revenue knocked down by 300 billion. Now, it's clearly something that is a body blow to any industry. So it's a question of how it's going to be possible to rebuild back and the ways that will actually make that happen. We can just cast a quick look back at what precedents there are. And the one that leaps to mind is one that's mentioned before, which is particularly what happened during SARS. So if we look at the way SARS impacted China and Asia traffic in 2003, and then put on it the kind of impact that we've seen in 2020, it's not dissimilar in terms of the bottoming out. It happened sooner in this case, but this degree of recovery seems to, at the moment, and clearly its first indications, but suggesting a similar kind of recovery pattern at the moment. But of course, these things could tail off. And the thing about SARS was that, as Peter mentioned, it was possible for the medical fraternity to get on top of that a lot quicker than something that has the transmissible problems and the detection problems of COVID-19. If you look at the impact on the world, you can see that there certainly was an impact in the months 1 to 6 occurring, but at the same time it was clearly oriented towards China and Asia, and you saw that rebound that was coming back and mentioned before, starting to come back after month 6, 7, 8, and so on. Another concern is, well, what did that actually do at the time in the previous downturns to current market values in terms of single-aisle aircraft, just one example. And what was seen was around a 15 to 20% reduction in current market value in the last 2 downturns. Just to finish off, but I'd first of all like to mention something about aircraft values and the process that we go through in Ascend. The key thing is a stepwise process informed by the market and not trying to lead the market. So at the moment, we are looking at the supply and demand parameters. We're looking at information on sales and forming our conclusions about what the current process will be. As you saw from that previous graphic, it was actually a stepwise process. It didn't suddenly drop overnight. So what you would expect is that there is a stepwise process in doing the evaluation of aircraft values and coming to conclusions about what they should be. So at the moment, in our first iteration on the key single aisle market values and market lease changes, these are the kind of numbers that we're coming up with at the moment. As I say, we're not trying to lead the market and not saying this is the ultimate value that these are going to fall at, but in a stepwise process, this is our view at the moment. So with that, I'd like to thank you and turn over to Nicola, I think.
Thank you, Peter. Yes, you're right. So our final speaker today is Nicola Dondy, who's a Managing Director at Goldman Sachs, who's located in Asia. Nicola, over to you.
Thank you very much, Victoria. Thank you, Peter. And thank you for the opportunity to contribute and speak in this webinar. I think what I wanted to do in the time left is talk a little bit about the market context. And then on the back of that, highlight some of the recent actions that airlines have been implementing to manage their balance sheets and really look for liquidity in order to weather the current volatility. So starting from the market context, just to reference a few numbers that could be relevant here when it comes to the stock performance. So if you look at the numbers as of a couple of days ago, let's reference the end of last week to be on the same page. I mean, and if we look then at the last 12 months of share performance for different indices, I mean, S&P 500, just to put things in context, is down by about 3.5% over the last 12 months. When we look at the US network carriers, the same number is 61%. For the leisure carriers, we're touching 45%. For ultra low-cost carriers, we're at about 57%. Canadian carriers are at 47% down, and Latin American carriers are at 50% down. So that is a pretty staggering market move if we think about the price action, even in the most distressed stocks of these stock exchanges and of these various indices. I mean, compared to oil and gas stocks, airlines have actually performed substantially in line, if not somehow worse. If we look at the lessors' equity action, I mean, without mentioning specific names, but you know, the best performer in the class is at around 26% down over the past 12 months. And some players have lost thereabout or substantially more than half of their market cap. So again, this is to illustrate the unprecedented nature of the market move. Moving a little bit into fixed income land and looking at aircraft financing first and choosing the WTC space as a market reference. That market has been functioning pretty well, obviously, over the past couple of years, with about 5 issuances over the course of 2019, fewer issuances in 2018 and 2017 due to a lower liquidity needs to be satisfied in that market, and notably one transaction done by Delta on March the 4th this year. That paper is trading generally at around mid to high 80s in terms of price when it comes to the senior tranches, all the way to 7 handles for the Class Bs and low 70s for deeper parts of the capital structure. And this is returning yields in the high single digit, mid to high single digit for most, all the way to low double digits for the deepest parts of the cap structure. The Delta transaction that was done in early March, as I mentioned, is currently trading at about 88 cents on the dollar for the AA tranche and 84 cents on the dollar for the single A tranche. So a pretty unprecedented move again. When we look at unsecured financing for airlines again, the paper is trading anywhere between 40 cents in the dollar for those that are perceived to be the most distressed names, all the way to mid to 80s for those airlines that have been able to showcase market access in the current environment and have been able to shore up liquidity. But some of the yield numbers are incredibly staggering. Some numbers are all the way to mid teens to high teen type of yield when it comes to the bid side of the curve for those assets. Then if we look at lessor debt, a similar picture with, however, a notable bifurcation in credit between those lessors that have effectively standalone operations and that are not part of bigger groups, which are suffering pretty much in line with how airlines are actually weathering the current volatility. And then those lessors that have a solid rating, in most cases driven by the type of ownership they have. So I'm thinking about the Asian lessors who, for the vast majority, are owned by banks. Those pieces of paper, those bonds, are actually trading at a material premium compared to the average of the market. So I think that's an interesting bifurcation that actually shows that obviously those lessors with certain ownership structures and therefore certain type of credit rating will certainly be at an advantage here when it comes to their ability to raise capital and withstand the current shock. And then as a last data point, I just want to talk about CDS market levels and the reference to, just to mention a couple of names. The American Airlines CDS over the past 12 months hit an historical low of 154 basis points for the senior CDS, and then at the highest of the current market volatility hit all the way around 2,300 basis points over. So again, an unprecedented move that can probably be compared to some market dislocation that we have seen during the great financial crisis when it comes to financial players, mortgage originators, and banks. So this is pointing to an environment where obviously capital is of scarce value. And what we have seen in the market is a meaningful advantage granted to those airlines that were quick movers when it came to raising liquidity in most cases, either through public transaction like Delta did and other airlines issued bonds in the first quarter of the year, in early first quarter of the year, but in most cases through bilateral transactions. So we have seen several $billion being raised by airlines through bilateral transaction as part of secured and unsecured transactions. And those deals were done, I would say, well ahead of the volatility entering into its most critical phase, when effectively the market was shut for any player, not only airlines. Those early movers were able to shore up liquidity, have therefore managed well their capital positions, their balance sheets, their covenants, and therefore are arguably less at risk of meaningful rating actions, which would further impair their overall ability to access capital. What we have seen also as a result of this is an increase in the amount of liquidity that airlines carry on balance sheets. Just to give a metric, by choosing a fairly representative sample set of airlines that report public filings across the world, the liquidity to revenue before the COVID crisis was in the mid-teens for a pretty representative peer set. Right now, that same number is touching 30%. So the amount of liquidity raised by large players is quite staggering. When it comes to the actions that have been taken, I mean, a wide range of action has been seen in the market over the past couple of weeks and couple of months. Ranging from managing capex, deferring orders, renegotiating to the extent possible and to the extent parties are willing, lease obligations. There has been an extensive amount of sale and leaseback transaction conducted by strong credits that still have access to that market, because obviously the credit worry is not only impacting the credit market, but is also impacting the leasing market. All the way to moves which are potentially indicative of distress situations, such as monetization of receivables, monetization of miles to credit card partners in order effectively to get advance on these agreements. So the view we have is effectively that airlines are really doing all they can in order to shore up liquidity and find pockets of collateral to deploy in order to achieve that. But obviously, what's top of mind at the moment are the rescue packages which are being implemented and that have been implemented around the world. Obviously, the one that is closest to home in the Singapore Airlines rescue package that was led by Temasek, we view that as really the gold standard for the packages that have been put in place. It's a comprehensive package. Is very large in quantum. It gives Singapore Airlines a lot of flexibility in terms of additional liquidity, and is obviously led by a blue chip shareholder that was already a shareholder in Singapore Airlines, so has shown even further commitment to the company. The package is made of about 90, or call it 20 billion Singapore dollars, 15 of which are equity and equity-linked instruments that are underwritten by Temasek, and the balance is a bridge provided by a commercial bank in the context of the recap. And we think that is effectively a very successful way of leading this type of operations, as by showing strong shareholder commitment, effectively market access is reestablished and the ability to go and raise capital in the capital markets or in the bank market is reestablished. Other governments have taken slightly different approaches. So still within the APAC region, Air New Zealand got a close to $1 billion New Zealand dollar rescue package by way of a loan facility that is about $500 million or US dollars or thereabout. That is a loan facility which is priced substantially in line with market. It is not an equity investment, which obviously protects the existing shareholders and to some extent the retail market that is invested in the equity of Air New Zealand. It comes with a number of governance and terms and conditions attached to it, as you would expect and as it is generally the norm for this type of rescue packages. Other governments in Scandinavia, when it comes to Norwegian Air and SAS, for example, have taken similar approach, i.e., instead of injecting equity, just provide bridge financing or loan financing in order to provide liquidity to the carrier to weather the current volatility. Generally, the time horizon that we have seen being implemented as part of these packages is through year end or potentially through 2021, depending on the perspective of the airline and depending on the perspective of the shareholder. But generally speaking, we expect these packages to be widely spread across the industry, especially for flag carriers and especially for airlines that are of national importance. I think we are all very keen to see the detail of the US rescue package being implemented. I think every day that goes by, some more detail is being unveiled. It's pretty clear that the amount of firepower will be meaningful, both in terms of direct grants and in terms of guarantees that are available to airlines to go and raise liquidity in the capital markets. We are also cognizant of the fact that those packages seem to come with pretty serious governance and terms and conditions attached, which again is pretty much in line with what we would expect. But we would expect a ban on executive compensation for as long as the rescue package is outstanding, a limitation on the ability to pay dividends, and so forth. So nothing quite unusual when it comes to, again, rescue financing, rescue package, and very much in line with what we have seen in 2008 and 2009 when it came to banks and non-banks financial institutions being bailed out by the respective governments, but obviously very unprecedented for the aviation industry and for the airline industry in particular, but very much warranted by the magnitude of the market event we are withstanding, as I hopefully illustrated through the data points I shared. Cognizant of time, Victoria, I will probably pause here and see if there are any comments or additional remarks from my colleagues.
Thank you, Nico. That's a great overview of the financial situation that I know is worrying everyone. We have had a lot of questions, and we are at the top of the hour, so we don't have time for all of them, but I just wanted to ask one, if all of our presenters could answer. I mean, there is a lot of concern that, as you said, the rescue packages are perhaps not meeting expectations, and there is a real risk of Chapter 11 and other similar kind of administration processes for airlines around the world. The concern is, I think, what the impact will be on many lessors, large and small, and also another question related to that is how lessors can perhaps work with strategic partners to weather the crisis. I guess, Peter Neglein, if you have any comments on those questions, that would be great if you could go first.
I think it's inappropriate for me to talk about our competitors in a specific sense. I'm sure they're capable of talking and presenting for themselves at the appropriate venue. But I can only speak for our own business, where it was a matter of we're fortunate to have both a strong parent, a listing in Hong Kong, and capital that was raised there that supported us as well. But I think it's a lot of pre-preparation. I think. As I said earlier, we saw markets that over the last couple of years that were fairly toppy, and we've kept a lot of powder dry, and you've seen that with the announcements so far between American Airlines and Cathay, and we still have interests in growing the business further.
Okay, thank you. And Peter Morris, do you have any comments around the risk of bankruptcies and what lessors can do?
Well, I think one way or another, you're going to see along the chain the traditional flight to quality. Now, whether you're talking about the routes that get re-established first, or whether you're talking about the airlines that get supported by governments or other investors, or whether you're talking leasing companies, what you're going to see is that people are going to try and cluster around the strongest markets and the strongest supply chains. And I think with the building collapsing at the moment, it's unclear exactly how that's going to play out, because all the time, I talked about the wider travel and transportation business of 10 trillion, but we're talking about the overall economy of the world. So everybody is going to believe they're a special case for support. And I think the key contribution that air transport makes to the global economy gives it a very strong case, but it's still going to have to fight hard.
Okay, and Nicola, I mean, you did touch on a variety of these points during your presentation, but is bankruptcy a real risk for both, obviously, airlines and the lessors that lease aircraft to them?
I mean, is it a real risk? Probably yes. I mean, it's difficult to deny that what's going on is pretty serious and could create some real concerns to some players. Look, I think when it comes to Asia is somehow sheltered, or better sheltered than other regions when it comes to their leasing players. As I mentioned, the vast majority of the lessors here in Asia are owned by banks who have very strong and deep pockets. And in most situations, those leasing entities are viewed as strategic entities of the group, and so therefore I think there is an expectation on the market side that effectively on all players that shareholders will step in and do whatever they need to do in order to ensure an orderly functioning of the companies themselves. But no doubt that smaller players with more struggling access to capital and no strong shareholders could and may struggle. The other thing I would say that we are hearing a lot in the market from market participants is that those lessors that have portfolios which are meaningfully weighted towards PRC carriers may weather this whole volatility slightly better than others, simply because given the situation in China where domestic traffic is slowly coming back, cash flows could actually come back on those portfolios sooner than for heavily international oriented portfolios. So that's another mitigant that lessors in our region may enjoy.
Understood. That's definitely something we all need to watch. So thank you everyone for sending in your questions. We haven't had time to cover them today, but we will be responding to you individually. And just before we leave, I'd like to thank all of our speakers today, Peter Neglein, Peter Morris, and Nicola Dondi. I think we had a really good discussion. And if you would like to continue the discussion, we're having a few more webinars, one on ESG, as well as one on the market in Korea in the next few weeks. So thank you very much for listening, and we'll be